Good evening. Thank you for welcoming me and for spending a part of your day with me. My name is Robert Okabe, as was told to you. I wanted to give you a little bit of, of an overview on the environment for angel investing in the EU and the US and in other developing markets. So every year in the US, about 60,000 businesses get funded by angel investors. About 300,000 Americans make an angel investment in any given year. These are data from the Center for Venture Research at the University of New Hampshire. So I'm one of those 300,000 people. I've formed an angel group, run an angel fund. I've made 14 investments myself. And I've learned in 15 years of doing this two very important things. First, this is the chair I sit in my office in Chicago. It's very similar to this chair, maybe not as nice. This chair cost me US $25,000. I made an investment in a company and I didn't know what I was doing. And that chair was all I got back. This is a box. This box is not much bigger than that projector. This box also cost US $25,000. But in it was the legal paperwork for the acquisition of the startup company by a Fortune 500 company, and that box was worth 19 times $25,000. So as an angel investor, sometimes you get a chair, sometimes you get a box. So what is an angel investor? Many of you here are already actively investing. Well, we are individuals, whether by ourselves or in small groups, 3, 5, 10. We invest in startup and early stage companies, investing in the entrepreneurs and their ideas. We don't work for these companies, and they are not our employees. We generally don't hold a controlling interest, at least not individually. We put up hard dollars. We put up our money, our capital goes into these companies. What the entrepreneurs put in are their ideas, their development work, their prototypes. So it's what we call sweat equity. Both sides take the risk of owners of a business. As was said in the video, part of what we do is to engage with entrepreneurs and expect for everybody to get a significant return. So all of these companies, including companies like Google, Starbucks Coffee, Amazon, and Yahoo, are all companies that were originally founded by angel investors. So the typical angel investor in Google invested 50,000 US. Today, his 50,000 US is worth 75 million. So sometimes angel investing is very profitable. So this is a company called Groupon. It is based in my home city of Chicago. It is a social networking buying site based on a software platform. So to give you an idea of the impact of small and medium enterprises in an economy. So again, it's a social networking software company. How many of you think Groupon has 200 employees? 500 employees? 1,000 employees? Groupon has 11,000 employees in 6 countries. That's the power of how the investment can multiply and not only create great value for you as an investor, but significant professional jobs in the locations in which a company exists. So, one of my colleagues on the board of trustees of the Angel Resource Institute, Mr. Goff, says, why should you be an angel? You should do 3 things. You want to do some good, make some money, and have some fun. But we're here mostly to talk about the financial side. This is my background. My background, if you've read my biography, is corporate finance. So with the Kauffman Foundation at the Angel Resource Institute, we sponsored a study. 539 angel investors gave up personal information on their angel investment portfolio. They belong to 86 angel groups across North America. They made almost 3,100 investments. 1,137 of those investments reached what we call a terminal event. Either the company liquidated and you got a chair, or was successful and you got a box. And there are important lessons to be learned from this data. But first, let's take a look at the profile of who angel investors are. So the typical median angel investor in this study, the 539 people, was a 57-year-old male with a master's degree. had spent about 9 years on the average investing in startup companies and put about 10% of his net worth in angel investing. Had made 10 investments, had generally seen 2 exits or closures. Half had seen more than 2, half had seen less than 2. Most of them were entrepreneurs. And the ones who were entrepreneurs spent almost 15 years in the entrepreneurial world before they became angel investors. And those angel investors who were former entrepreneurs had started almost 3 companies each. So they were serial entrepreneurs. So these people have significant experience investing, being entrepreneurs themselves, starting companies themselves. How did they do? Well, if you look at the 1,137 companies that received an exit, if you had invested in all of those companies, good and bad, you would have received back 2.6 times your money in a little bit over 3.5 years. And as a result, you would have made 27% per year on your money. So that's a very good return from a financial perspective. But it's important to understand the concept of the box and the chair. So of those 1,137 investments, 35% of them, a little over 1/3, failed. The companies failed. But what happened is, in 48% of the cases, the companies were profitable, and in this 1/6 of the cases, created significant investment returns. This little slice here is where you would find a Google or a Groupon. Those companies that return 30, 50, 100 times your money. So about 15% of the deals drove the returns. So those of you who are angel investors and those of you who are considering it need to understand that it's a relatively high-risk opportunity. So where do angels play? Angels play in the middle. Most entrepreneurs, you start with their personal savings. They'll quit a job to start a company. Or they'll build up their idea, build up a prototype of their product or service while still working full-time. And they'll generally tap into their savings. In the US, it's anywhere from $25,000 to $100,000. Then they'll normally go to friends and family, people who are close to them in their network, who generally provide $100,000 to $250,000 US to the entrepreneurs. Now, in the US, we have this myth of venture capital and how venture capitalists fund all the startups. It's true, venture capitalists funded Groupon, Google, Yahoo, Starbucks, all of the companies you saw on that previous page. But generally in the US, venture capital deals start at $2 million and up. The average venture capital deal in the United States in 2011 was, I believe, $7.8 million. So how do you go as an entrepreneur, as a small company, from justifying $2 million or more in capital request, from taking small amounts of money from friends and family? And that's where angel investors come in. That's the $250,000 US to $2 million US. It's 300,000 angel investors. It's 60,000 companies a year. We fill that gap to help create the future Googles and Groupons. So we talked about venture capital. Well, each year in the US, only about 1,000 companies receive their first venture capital. 1,000 out of those 60,000 that have been funded by angels. 1,000 out of 600,000 new businesses that are started in the United States every year. And that's data according to the US National Venture Capital Association. So the Venture Capital Association's own data says they fund less than 1% of entrepreneurs in the United States. And so it's important to understand the value of how angel capital catalyzes additional investment, creates jobs, also creates building of wealth for investors and for entrepreneurs. So when we take the data from the National Venture Capital Association and from the Center for Venture Research, what we see is at the earliest stages of development that angels provide 90% of the capital in the US. So the myth of venture capital building all these great companies wouldn't get to venture capital to expand and to their later stage development if they didn't start here. In what we describe as early stage capital, that is a company that's less than 3 years old, angels still provide over half of that money. It's only when companies get to the later stages of development where they need significant growth capital that where venture capital dominates. And then it provides 80% and then almost all of the funding for the highest growth entrepreneurs. So it's important to understand that there's a transition from mostly angel to mostly venture capital. Those of you who saw the London Olympics, saw the relay races, the 4x400 meter race, think of the entrepreneur as the person who runs the first leg of the race. He hands the baton. Somebody must take it. Those are angel investors. They run the second leg of the race. After that, who takes the baton? It's the third leg. It's the venture capitalist. And then where does the fourth leg come? When the company experiences an exit and provides value and monetizes the wealth for all involved. So what you see here is this transition, this hand of the baton from angels to venture capitalists. So if you look at the data from 2011, which is the last full year we have, again, about 66,000 companies funded by angels, only 3,700 companies funded by venture capitalists. Of those 3,700, only about 900 were totally new investments, a company who had never received venture capital before. So again, to recap, the difference is angels invest their own money and venture capitalists invest other people's money. This is the most important distinction. For us, it's our capital. It has a personal aspect to it. For a venture capitalist, it's your capital. They're investing in other people's companies. It's a job. It's a good job. It's a job many of us might like to have someday in our careers, but it's still a job. So we may invest in a wide range of things based on our own personal expertise and preferences, based on the expertise of people we know and the networks that we build. Venture capitalists tend to focus very tightly on areas where they have the personal expertise. Remember, they're employees of their fund management company. And so what they do is they stay internal and only invest in those things internally that the team has the expertise in. When we invest our own money, we're not paying fees to anybody. When you put your money in a venture capital fund, their employees, how do they get paid? They take fees from your money. Hopefully both of us will make a return, a significant return. We are both actively engaged with the entrepreneurs. Angel investors are more patient. We tend to be willing to work with entrepreneurs, help them grow. Speed is not as important as creating real value because we're all businessmen ourselves. Venture capitalists, on the other hand, have to start their next fund. Their job is to create wealth, but their other part of their job is to create their next fund. So their companies have to get out. They have to try to liquidate their portfolio in less than 10 years. They don't always succeed, but that's what they try to do. And that artificial deadline can sometimes alter how companies perform in the marketplace. So in between individuals investing for ourselves in companies that we see, and venture capitalists making large investments institutionally, are angel groups. And so angel groups are where we still invest our own money, we still make our own investment decisions, but we work with others and combine our funds to fund companies. We also combine our experience and our expertise. Some of you may have interests in technology and construction and industry and chemicals, in semiconductors. You'll have that wide range of experience to be able to leverage when you work together with a group. If we have expenses, we share them, so those expenses are lower for each of us individually. We can actively be engaged with entrepreneurs, but all of us can. So we don't have to spend as much time individually with the companies that we're investing in. And that helps the companies on the path to exit. So far, this might sound like a good model, but you may be saying to yourselves, prove it to me. If this model is so good, why isn't it growing? And it is. So in North America, Canada, Mexico, and the United States, when I first started as an angel investor, there were less than 100 angel investor groups in North America. In 2012, we estimated at the Angel Resource Institute that there are 375 angel groups. So the number of angel groups is almost quadrupled because as individual investors see the value of combining capital, combining expertise, and sharing workload and expenses. So almost 4 times as many groups. These groups are now banding together in larger associations. In North America, the Angel Capital Association has 175 angel group members. They represent over 8,000 individual investors. Based in Brussels, the European Business Angel Network represents over, I believe, 60 angel groups and over 3,000 investors. And then as was mentioned, I'm on the board of trustees of the Angel Resource Institute. We're a nonprofit organization. We do education and research and training of angel investors around the world. So for those of you who are angel investors or considering it, the first question you might ask is, how do I find opportunities? What we call deal flow. Where does deal flow come from? So what we did is we took a survey of angel investors and angel groups. We got 58 responses to a survey that we sent out to about 180 different groups. And we asked them to rank 7 types of referral sources from best to worst. We said, for each of you, rank one of them number 1, best, and one of them number 7, worst, and then we compiled the scores. And what we found was overwhelmingly investors like getting deals from other investors. People who have the same experiences, take the same risk, expect the same reward. The next best group was entrepreneurs. Angels like getting deals from entrepreneurs, especially entrepreneurs who've been funded before. But interestingly, in follow-up interviews, we asked, and the investors we talked to said, even if an entrepreneur has failed, we would appreciate a referral from them because they know what the process is. Yes, they failed in their business, maybe I lost some money, but hopefully the entrepreneur learned from that experience, and when they make a referral to me, that referral is strong. The next are incubators and accelerators, such as the programs that Batter is putting together. And so what you can do in an angel group, working with Batter or in Jeddah with Sirb, you would be dealing with the top 3 of the 7 referral sources for angel investment opportunities. What we found is experienced angels don't like websites. They can't trust who's on the website. Is it real? Is it a video? How do they vet it? And so that's on the negative side. So angel groups are efficient aggregators of deal flow. An angel group, you set up an organization, the organization becomes known in the community. That organization provides to you deal flow as that organization becomes known in the community. The typical angel group has about 35 members in the US, and so members are reviewing the deals. So you don't have to look at all 35 deals every month. You can look at 5 deals. You might review 5 and share your findings with the rest of the group. Each of you might review 4 or 5. So it's less work for you. And you will probably only review deals that are near your areas of expertise or interest. And a group can have an interest with an institution, a university, or an economic development organization who can also help provide deal flow. You don't have to build all these individual parts of the network. The group builds it for you through the public awareness. Because you're sharing the load of screening the transactions, the deal flow is vetted. You're accepting these candidates from the reliable sources, and you're using a process to screen through them. But to me, one of the best things about being a member of an angel group is to be anonymous. I think the last thing I want to do is put a sign on my head that says, I give money to entrepreneurs. I know at least in Chicago, I couldn't walk down the street without being asked by 10 people, would you give me money? And so I appreciate being a member of a group where nobody knows my name unless I choose to reveal it to them. So, do angels invest in established companies or pure startups, just an idea? This is a big challenge. It depends on the market. So across the US, people think the US is one market, just as I, in my first time here, thought Saudi Arabia was one market. What I find is there are different regions, different customs within the regions, in different dialects. Right? People from Jeddah are different from people here in Riyadh. I didn't know that. And in the US, it's the same. And so in places like Missouri or Kansas, things are very different than they are in Silicon Valley or Research Triangle Park. And so what kind of company should you invest in? Well, let's take a look at a study. This is a study by the California Public Policy Institute. And it asked, when companies get to the stage of receiving venture capital, how old are they? Everybody hears these stories in these online forums and in these magazines about how somebody with just an idea and maybe 2 pieces of paper gets venture capital. And that certainly does happen from time to time. But what we found that in Silicon Valley, San Francisco, and Boston, during the period of this study, the typical company that received venture capital was 13 months old when it received venture capital. And outside those locations, but within the United States, The typical company was 19 months old when it received its first venture capital. So the question, if you're trying to build an entrepreneurial ecosystem, is what happens from month 0 when the entrepreneur is using their savings to month 19 when they're strong enough and exhibit the performance to attract institutional capital. This is where angel capital comes in to help make that leap. And so angels will invest in companies that are anywhere, in the US at least, from brand new to about 1.5 years old. So it's important to understand that in most markets, if you're investing in companies that are going to attract later rounds of capital, that company's going to have to show some positive performance. So think about investing in companies that are brand new to perhaps up to 2 years old as an angel investor. So what industries do angels invest in? And the answer is angels will invest in a wide range of industries. So at the Angel Resource Institute, our staff surveys angel investors and angel groups across North America. We have about 120, I believe, angel groups who participate in a quarterly survey. And in our last quarterly survey, we said, where are you investing? And basically 1/3 of deals are internet related. Now this is an old category listing. Types of deals change. Internet can be everything from social networking to software to e-commerce. The second largest sector is healthcare. Medical devices, healthcare, IT, even biotechnology. 24% of angel deals are in that field. Mobile and telecom, this is much more devices and hardware, not software and apps, 10%. Industrial, 8%. Software, not internet, 5%. Energy and utilities, and other categories. So angels invest in a wide range of things. And so how do they do that? They rely collectively on their networks. My background is financial. I don't have a medical device background, but I've invested in a medical device company. Why? One of the investors who I got to know through my network had spent 20 years in the medical device industry. And so then I'm able to invest in the newest technologies, not blindly, making a guess, do I know this, will it work? But with the assistance of somebody who is an expert in the field. So how long do startup companies take to reach the exit? How long does it take until you get your money back and you realize a return on your investment? Well, you remember that study, 539 investors, 1,137 exits. And so for those deals where you lost money and the company liquidated, that took on the average about 3 years to find that out. The company lasted about 3 years before they found that out. This was the median holding period of investment. What happened is for those companies that were like Groupon, like Google, like Yahoo, the large successes, those on the average took it 6 years to reach the exit. So it's important to understand the way we call it, using agriculture as an example, lemons rot faster than plums ripen. And so you should expect that your very best investments will take 6 or more years to come to market, whereas your failures will probably happen in 2 years or less. I'm a living example of that. The one where the box, I received 19 times my money, took 7 years. When I got the chair, it took 18 months. So it's important when you're investing to understand that you will have your initial failures. They will probably happen before your big successes. And so it's important to understand the timing of when that will happen. So you might say, well, but who could predict Facebook? Who could predict Amazon? Who could predict Google? Why not just invest a little bit of money in everything I see? Why study? Why do the analysis? Why not just guess? And the answer is that it's the same for angel investors as it is in traditional investments. Those of you with a financial background know the book, The Random Walk Down Wall Street, where if you just throw darts at a listing of stocks, you might do the same as investing in companies that you analyze. Well, that's not true in startup investing, in entrepreneurs, because these companies have no track record. You can't just throw the darts. You need to think about doing due diligence. You need to think about doing some analysis of how good are these people? How good is this product? How good is this market? And so again, falling back to the study, and remember, this is 539 investors, 20 times the number of people in this room. If you invested in the companies for those 1,137 investments, the average amount of time, the median amount of time spent investigating the company was 20 hours. Half of them were over 20, half of them were under 20. If you invested in all the companies that spent less than 20 hours on due diligence, all those investments, if you made all those investments, you barely got your money back. We're using the term investment multiple here. So when I say you get 1x your money back, you get 1 times your money back, you barely broke even. If you invested in the other half of the companies, only those companies where you spent more than 20 hours of due diligence, you would have received 6 times your money back. So it is 6 times better to do the analysis of due diligence than to just invest blindly. If you invested in the 25% of companies, the top 25% in terms of number of hours invested in analysis and investigation of the opportunity, you would have received 7 times your money. So maybe it's not so much value out of that initial effort to go from at least 20 to 50 hours or more, but it is significant value to go from not doing anything to doing about 20 hours worth of due diligence. So now I know you're thinking 20 hours. I don't have 20 hours to investigate every entrepreneur that I want to deal with. And again, it's one of the parts, one of the value propositions of investing together with others. If there are 4 of you, you only need to spend 5 hours each. If there are 10 of you, you only need to spend 2 hours each. And so it makes the investment process easier. So again, this collective due diligence is more efficient. Why? First of all, you're dividing the work. Less work for me, less work for you. But the total amount of work provides that value. How do you divide it? You might divide it based on your expertise. If somebody is a lawyer, they might investigate the legal aspects of the company. Somebody with a financial background might look at the banking and financial statements. Somebody with a background in the industry or in sales or dealing with governments if the government is a customer for this company. You also get multiple perspectives because none of us is right all the time, but collectively we can balance our enthusiasm with skepticism to come up with a rational answer. There are pitfalls to investing in a group, doing due diligence as a group. What if somebody doesn't do their part? They don't do their 2 hours or 4 hours. How do you fill that gap? Sometimes people in a group can start to think together. So I'm Japanese. We're famous for groupthink, right? And so that's a risk. And honestly, you're seeing it in Japan's industrial policy today. The risk of groupthink and how some great companies like Sony, Toyota, Panasonic are having hard times. Why? Because they're locked in groupthink, and you want to make sure that doesn't happen. So you retain your rights as an individual to decline or make an investment. So should you sit back and watch, just put your money in and hope the entrepreneur does well, or should you engage with the entrepreneur? And so again, we look at those 539 investors and we ask the question, how often did you talk to the companies? How often did you engage with the entrepreneurs? And what we found was it was a little bit of a U-shaped curve. There were lots of companies where they only heard from the company 1 or 2 times a year. And there were lots of companies where they would hear from the company 1 or 2 times a month or more, or even weekly. And there weren't many in between. The entrepreneurs either seemed to engage with the investors or not. Well, if you invested in all of those companies where the investors said the entrepreneur never talked to us, again, you barely got your money back. If you invested in all those companies where the investors said the entrepreneurs talked to us all the time, you got almost 4 times your money back. So there's a saying by Josh Lerner of the Harvard Business School, based on a study. He estimated that the economic value of the expertise, contacts, and experience of investors provided more value to the success of the companies than the money itself. The network was worth more than the money. And so if you're going to put your money in a company but not provide that company with your network, you're basically saying, I am willing to accept a lower return on investment. So it's important as an angel investor to decide to engage. But this can be a lot of work. Do you have time to talk to an entrepreneur 2 or 3 times a month for multiple years? Maybe not. But between 6 of you, do you have time to talk to an entrepreneur once every 2 months? For a few years? Yes, you do. So again, investing together, whether in an organized group or an informal network of a few investors, does have significant value. It's important, however, to understand that you're really trying to let the entrepreneur grow as a business person, to become hopefully as successful as all of you are. Think about Facebook. It still makes me crazy that Facebook is run by a kid who can't tie a tie. But the investors invested their time in him. And the company grew to the extent and he was able to grow with it. And so yes, there are hundreds of people, if not thousands of people on the staff now, and they do most of the things that make a normal company run, and the company has a lot of infrastructure. But he's still the CEO. He still can't tie a tie, but he's still the CEO. Why? Because the investors invested the time to help him grow, and he grew that company probably better than any of them could. So it's important to make sure that you don't micromanage. And if there are 6 of you investing in a company, you don't want 6 people calling the entrepreneur every single day or every single week. Then the entrepreneur never gets anything done. So at this point, this is kind of an overview, and we wanted to use a lot of data to show you what the process looks like. I would, before going into some specifics on how the deal process seems to be working in today's market, I would ask if any of you have any questions about the material that I've presented so far. Yes?
Regarding the VCs, 15 months is very soon for the VCs to come into a company, from what I see. Because when I understand VCs are not the big risk takers. And 15 months, the company doesn't have time to show its financials or a track record. It could attract a proper VC to that company. And just a general knowledge, VC activity in Saudi Arabia, very, very minimal. Over the last year, maybe 2 large private equity companies came to Saudi Arabia, and they only made 1 million each.
Right. So that's a very good question, and I would respond with the following. So in the venture capital industry, the median is 13 to 19 months. But that means that there are a lot of them that go much longer. And so the venture capital industry, just like I say, Americans aren't all the same, Saudis aren't all the same, VCs aren't all the same. There are earlier stage VCs and later stage VCs. And so you have relatively small number of early stage VCs who invest in month 13 to 19 and go to year 2.5. But you're right, most of the VCs, the big bulk of them, will start investing when a company is 2.5 to 4 years old and take that company to 7 to 8 years old. In the venture capital industry, the average time to exit is almost 8 years now. So the bulk of the money is coming later in the process. So one of the things that you have to deal with as an angel investor in a different market is, how long do I think the company will need money from me and my colleagues before attracting institutional capital? Is it 1 year? Is it 3 years? Is it 4 years? And then you have to decide. That's one of the criteria for making an investment. So again, in the United States, it's different. I have a map that we talked about that unfortunately is not on this computer. In 28 of the 50 United States, there are less than 25 venture capital deals a year. 75% of venture capital in the United States is concentrated in 4 states: California, Massachusetts, New York, and Pennsylvania. So in 46 of the 50 United States, they face the same issue you might face here. And so, again, it's part of building a network of other investors. You might choose to invest in a company that's 6 months old and provide it you with a year's worth of capital. You may know people in your network who will say, oh, it's 18 months old, you're pretty happy with it, they seem to be doing well, I'll put in capital. And you build that network. What we're seeing is collaboration among angel groups, not only in the US, but also in Europe, where groups of investors are following on together. So they will do a $500,000 US round. The angel group could provide all of that. But what they choose to do is provide $250,000, get another group to provide $250,000. Then a year later or a year and a half later, when the company needs $1 million, they're comfortable because they only did $250,000 the first time. So each group is comfortable doing $500,000. So again, one of the things about building up a network of not only deal flow sources, but a network of other investors, is it allows you to bridge that gap when there's a smaller amount of venture capital in the marketplace. And so it's definitely something to think about. And that varies by market. I have to admit that I do not know as much about this market as I do others. The Angel Resource Institute has been in Turkey for about a year. And so, we've been working with people there to try to build that network. And now there's 4 or 5 angel groups in Turkey who are starting to talk to each other and share deals in order to bridge that gap. And so we expect that in other markets as well. Yes?
Another question. To follow up on what you just said, which is the first stage, second stage, and third stage investment. That's not very popular because it somehow feels like a pyramid scheme. Whereas, the second stage, you can help the first stage people exit, and so on until somebody ends up with the ball in his hand. How do you feel about those kind of processes?
So first of all, I have a personal rule, which most angel investors in the US and the EU follow, which is, I will not put any money in if anybody else gets to take any money out. If somebody gets to take money out, my money doesn't go in because it is a pyramid scheme. So I would recommend not putting money in. Everybody should get out at the same time. Maybe the people who invested first make more because they invested at a lower valuation, because they took greater risk. But if anybody gets out of a deal with my money, they never see my money. That's how I fix that.
Last question.
Okay.
And your charts, you have 2 charts. One is the due diligence chart.
Yes.
The other one is the interaction chart.
Yes.
They're probably related because the person who's not interacting with the company is also going to be successful.
Yes, we believe there's a high correlation.
And basically not caring about the investment, just mostly like gambling. Just give them the money and just
Oh, I don't think it's like gambling. I think it is gambling. No, I mean, that's exactly right. You have to choose it. Angel investing is something, again, make a little money, do a little good, have a little fun. So the fun part is helping people, helping somebody else's success, bringing them along. But if I wanted to give my money away, I would give it to charity. I want to make money. And so if I can invest my time to improve my chances of investment, I'd be a fool not to. So, I look at it this way, right? So there's the investor in the US, Warren Buffett. He's a multi-billionaire. He's written books on, this is my investment philosophy, this is how I do it. I don't understand why anybody does it any different way from him. I don't understand why every American just doesn't buy his book and follow that process. But yet millions of Americans don't. Millions of investors, tens of millions of investors don't. So I would rather be the one that does. And I think as an angel investor, if you're going to choose to be an angel investor and you don't want it to be gambling, then you need to think about how are you going to do due diligence, how are you going to keep in contact with the companies, how are you going to help the entrepreneurs grow. Yes?
In general, regarding the legal framework of an angel investment, let's say there's a case of underperformance by the side of the entrepreneur, or the complete underperformance decides to leave the project and so forth. What are your channels of recourse?
So it depends on how you've structured the deal. In the US, we're famous for having too many lawyers.
Sure.
But one of the benefits of having too many lawyers is you can find a few smart ones. So for example, what a lot of angel investors do is they require an employment contract before they invest. Yes, you're the founder, you're an entrepreneur, you're the owner, you're the current CEO, but if you quit, you may not compete. And in many parts of the US, non-compete agreements are enforceable. And so you say, for 2 years, you can't compete with us if you quit in the middle. Another thing would be to take away the shares. If you quit, we get to buy back your shares for a penny a share. So what we create is incentives for that entrepreneur to stay if we want him to stay. So one of the things is we don't want him to quit and compete with us, and we don't want him to enjoy the benefits of being a founder and getting stock if he quits on us. So those are some methods. Alternatively, the other part of that employment agreement gives the board of directors the right to fire him, even if he's the majority owner. And so you have a clause in the agreement that says, the board may fire the CEO. So you can get rid of him. So there's the famous venture capitalist John Doerr of the big firm Kleiner Perkins, and I'm probably misquoting him, but the quote goes something like this: I'm 100% behind every one of my portfolio company CEOs until the day I fire him. But you have to build into the structure those protections from a bad entrepreneur and the ability to protect yourself from a good entrepreneur who decides to leave. But there are ways to do that.
What level of involvement would you have in how the cash is spent? Would it generally be dictated initially with the initial investment that this amount will go to use different investments and so forth, or if it's purchase of materials or prototypes, whatever it would be?
So the interesting thing with that is, and we'll talk about it in the second half of the presentation, is the concept of the business plan. And the business plan is like a still photograph. This is what you drive by a construction site, right? There's a beautiful picture of the finished building, right? But sometimes for months, sometimes for years, sometimes for decades, all that exists is the sign and maybe a skeleton. The challenge with fixing the dollar amounts based on a business plan or the current strategy is that it never works out quite the same. Something happens. And so if you fix it too tightly, you make it impossible for the entrepreneur to change direction when the situation changes. On the other hand, you don't want the entrepreneur to just go out and write checks for whatever they want. So there are a number of ways to do that. One is if, let's say, a startup wants 500,000 reals. You don't give them all 500,000 at once. You say, here's 200,000, and let's see how it goes. And if you do everything you say you do, we'll put in the other 300. But we're not giving you all 500,000 now. So that's one way to do it. Another way to do it is to put a limit on how much the CEO can approve. So in the US, the standard is $25,000, which is about 90,000 reals, I think. So you could say any single expenditure over 100,000 reals must be approved by the board, not just the CEO's signature. So you can put some limits on them while giving them that flexibility. And so that's one of the things that we talk about at the Angel Resource Institute, and we're really pleased to work with the people at Bader and Sirb to be able to bring those lessons together. So we have a series of 8 educational programs. We do about 200 programs a year. We've been in 10 countries outside the US. Most notably this year, we were in Jakarta in Indonesia. We were supposed to be in Istanbul next week, but that got moved to February, where we talk about these specific things and teach investors how to implement these processes and procedures to provide that balance of protection for you as an investor with freedom to operate for the entrepreneur. So we're really pleased to be entering into the same sort of arrangement with Sirb, hopefully starting in January. But yes, there are many ways to do that. And so, you know, when I started out as an investor, I only knew some of these things. I spent most of my years, if you read my biography, in investment banking, so I knew most of the tricks because investment bankers, well, they're investment bankers. But you learn them over the years. So what we do in our programs is try to bring that knowledge to you. And what we'll talk about in the second half of the presentation is specifically how investors are viewing the materials that entrepreneurs provide. But there are lots of things like that that can be picked up from either a good network of experienced investors or from seeking out those resources in the marketplace.
So we have a break, 2-minute break. We will continue the second part of the presentation. We will have our dinner at 8 o'clock.
Thank you.